January 26th, 2026, silver hits $114 per ounce, but the price doesn't matter anymore because TD Bank, one of North America's largest financial institutions, just did something unprecedented. They turned off the buy button completely. Not a glitch, not a delay, a full suspension. Their vaults empty, their website dark, and they're not alone. Goldman Sachs just fired their global head of precious metals trading. In the middle of the biggest boom in history, why would you fire the king unless he just lost the kingdom? Meanwhile, Shanghai closes at $120, a $9 gap above New York. The metal is flowing east, and it's never coming back. What you're witnessing isn't a market move. It's a market fracture. Welcome to John Analyst, where we cut through the noise and deliver the economic intelligence that serious decision makers actually need. If you've built a career making calculated decisions, if you understand that information is currency, then you're in the right place. Do me a favor. Hit that subscribe button below, not because I asked, but because missing the next briefing could cost you more than you're willing to lose. And drop a comment. Tell me where you're watching from. New York, London, Singapore, Mumbai? Because what's happening right now isn't happening in one city. It's happening everywhere, all at once. Let's get into it. On the morning of January 26th, 2026, the financial architecture of the retail precious metals market experienced a structural failure that most investors will not fully comprehend until it is far too late to act. Silver is trading near $114 per ounce. The headlines are screaming about the price. The financial media is focused on percentage gains. But the price has become irrelevant. Because today, the fundamental question is not what silver costs. The question is whether silver can be obtained at any price through traditional banking channels. TD Precious Metals, the bullion division of TD Bank, one of the largest Tier 1 financial institutions in North America with assets exceeding $2 trillion, has officially suspended all sales of physical investment silver. This is not a temporary inventory shortage at a regional coin dealer. This is not a website experiencing technical difficulties due to high traffic volume. This is a systematic shutdown of retail access at the institutional level. When a customer logs into the TD Precious Metals portal this morning, they do not see pricing. They do not see an add to cart function. They see a grayed out interface with a single banner notification reading temporarily unavailable. The language is carefully chosen. The term temporarily suggests a brief interruption, a minor inconvenience that will be resolved shortly. But the operational reality tells a different story entirely. The mainstream financial press will attempt to frame this development as a logistics challenge. They will cite unprecedented demand as the explanation. They will suggest that TD Bank is simply experiencing supply chain delays and will resume normal operations once inventory levels stabilize. This narrative is strategically misleading. What is occurring at TD Bank is not a supply chain bottleneck. It is a bank run, but not a conventional run on currency. This is a run on tangible assets. And the institution has nothing left in the vault to distribute. The distinction is critical for business decision makers to understand. A logistics problem implies temporary disruption with eventual resolution. A structural collapse implies permanent change in market access conditions. TD Bank's suspension represents the latter. The institution is not waiting for a shipment. They are locked out of the wholesale metal market entirely because that market has ceased to function in any traditional sense. For months, sophisticated investors and allocation strategists have warned that there would come a point where fiat currency liquidity would become irrelevant in the precious metal space, where the ability to convert cash into physical assets would simply vanish, regardless of account balance or purchasing power. That theoretical warning has now materialized as documented fact. Consider the position of a business owner or corporate treasurer holding significant cash reserves in a TD Bank account today. They recognize the inflationary pressure on their capital. They understand the strategic value of hard asset allocation. They have the liquidity to execute a metals purchase, but the bank is now telling them explicitly, we cannot facilitate this transaction. Your capital is trapped in the digital ledger system. You can see the number on your screen, but you cannot convert that number into the only asset class that is holding value. This is not market volatility. This is the systematic removal of exit options for those who waited too long to reposition their holdings. The timing of this suspension is particularly significant. We are not at the beginning of a precious metals rally where early inventory depletion might be expected. We are well into an advanced commodity cycle with silver, having already moved from 40 to 114. TD Bank has had months to anticipate demand patterns and secure inventory from refiners and wholesalers, yet they arrive at the critical inflection point with empty vaults. The strategic question that must be asked is, why did a major financial institution fail to stock inventory during the most obvious buying opportunity in a generation? The answer to that question reveals a catastrophic miscalculation at the institutional level. A miscalculation that will be examined in detail as this analysis continues. But the immediate tactical reality for investors and business strategists is this. TD Bank is the first domino. Every other major institution with a precious metals desk is operating under the same mathematical constraints, facing the same wholesale market dysfunction, and approaching the same breaking point. The retail buy button is being systematically deleted from the global financial interface. And once it disappears completely, there is no pulling back available at any price. The question that separates casual observers from strategic analysts is not what happened at TD Bank, but why it happened. And the answer is far more damning than a simple inventory miscalculation. TD Bank did not arrive at this crisis because they failed to anticipate demand. They arrived at this crisis because they actively bet against their own customers and lost catastrophically. 6 months ago, when silver was trading at $40 per ounce, the proprietary trading desk at TD Bank made a decision that would eventually destroy their entire physical metals operation. They looked at the charts, consulted their quantitative models, and concluded that the rally was unsustainable. Retail investors were exhibiting irrational exuberance. The smart money, the institutional money, would fade the move and profit from the inevitable collapse. They initiated a massive short position. For those unfamiliar with derivatives mechanics, shorting silver means selling contracts for metal you do not physically possess, with the expectation that you will buy those contracts back at a lower price and pocket the difference. It is a bet that the market will fall. And when executed by a major banking institution, it is a bet backed by hundreds of millions of dollars in capital. TD Bank's trading desk sold paper silver at $40, expecting a retreat to $30. Instead, the market ripped to $50, then $60, then $74. At this point, a disciplined risk management team would have admitted the error, closed the position, and accepted the loss. But institutional traders do not operate with that level of humility. They operate with leverage, ego, and an unshakable belief that they can outlast retail momentum. So they doubled down. At $74, TD Bank shorted again. They deployed additional capital, not to accumulate physical inventory that could be sold to customers during the rally, but to suppress the rally itself. They were attempting to use brute force selling pressure to break the market, its upward trajectory, and prove their original thesis correct. The market did not cooperate. Silver continued its ascent, and somewhere around $92.50, the mathematics became unsustainable. This is where the margin call occurred. When a short position moves against you beyond a certain threshold, the clearinghouse that facilitates the trade issues a demand: either deposit additional collateral immediately, or we will forcibly close your position at the current market price. TD Bank received that call, and they had no choice but to capitulate. They were forced to buy back every ounce of paper silver they had shorted at $92.50, locking in a loss estimated to be in the tens of millions of dollars. But the financial loss, as severe as it was, is not the most damaging aspect of this failure. The real catastrophe is the opportunity cost. Think about the timeline strategically. For 6 months, TD Bank had capital available. They had access to refinery networks. They had relationships with wholesalers in Switzerland, Canada, and Australia. They could have been accumulating physical bars and coins during that entire period, building inventory to meet the demand surge they should have anticipated. Instead, they used that capital to fight the market. They burned their ammunition trying to stop a freight train. And now with silver at $114 and customer demand at historic highs, they have no metal to sell because they wasted their resources trying to prove that customers should not want to buy. This is not simply a bad trade. This is institutional malpractice. And the consequences are compounding. Because now, even if TD Bank wanted to restock their vaults, they cannot. The wholesale market has disintegrated. Refiners are sold out on forward orders extending into 2027. The metal that is available is being shipped east to Shanghai, where premiums are $9 higher than New York. There's no rescue coming. So TD Bank's trading desk made a gamble and lost the gamble, and in the process destroyed the infrastructure that would have allowed them to serve their customers during the most profitable period in precious metals history. They are not a victim of market conditions. They are the architect of their own irrelevance. And they are burning alive in a crisis entirely of their own creation, while every other major bank watches and realizes they are next. While retail customers are discovering that their banks have locked the vault doors, something far more revealing is unfolding inside the executive suites of Wall Street's most powerful institutions. Heads are rolling, and the silence surrounding those terminations is more informative than any press release could ever be. On January 26, 2026, the same day TD Bank suspended silver sales, a name disappeared from the organizational chart at Goldman Sachs. Not a junior trader, not a mid-level analyst. The global head of precious metals trading, a man who controlled the largest order flow in the Western Hemisphere, is no longer with the firm. His name is Benjamin Ben-Alain, and until this week, he sat at the center of the precious metals universe. His desk processed billions of dollars in transactions, His decisions moved markets. His phone rang with calls from sovereign wealth funds, central banks, and hedge fund titans. He was, by every measurable standard, one of the most influential figures in commodity finance. And now his badge is deactivated. His office is empty. His direct line goes to voicemail. Goldman Sachs issued a statement, the kind of carefully sanitized corporate language that is designed to say nothing while appearing transparent. They indicated that Mr. Lane had departed to pursue other opportunities and wished him well in his future endeavors. The financial press dutifully repeated the narrative. Some even speculated that he had been recruited by a competing hedge fund with a more lucrative compensation package. This explanation is absurd on its face. You do not leave Goldman Sachs in the middle of the most violent, profitable, historically significant commodity rally since the 1970s to pursue other opportunities. You do not walk away from the table when the pot is this large, unless you are escorted out by security. Let us examine what likely occurred inside that trading room. Traders at Goldman Sachs are not trained to follow trends. They are trained to exploit mean reversion. They are taught that markets are elastic, that extreme moves in either direction will eventually snap back to equilibrium. This philosophy works exceptionally well in stable, low volatility environments. It fails catastrophically during structural regime changes. When silver reached $80, Benjamin Ben Lane almost certainly initiated a short position. He would have viewed the move as irrational, driven by retail speculation rather than fundamental supply-demand dynamics. He would have calculated that a reversion to $70 or $65 was inevitable, so he sold. When silver reached $90, he likely increased his position size. This is standard practice for institutional traders who believe in their thesis. If you are confident that the market is wrong, you add to your position as it moves against you because the eventual correction will be more profitable. But the market did not correct. It accelerated. And when silver crossed $100 and continued climbing toward $114, the mathematics became existential. But Goldman Sachs does not trade in small size. When they take a position, they are managing exposure measured in millions of ounces. A $30 adverse move on a 10 million ounce short position represents a $300 million loss. That is not a quarterly write-down. That is a career-ending event. That is the kind of loss that triggers emergency risk committee meetings. That is the kind of loss that results in immediate termination. Benjamin Ben Lane was not fired because he made a bad trade. He was fired because he made a trade that assumed the old rules still applied and discovered that the rules had fundamentally changed. But the broader implication is even more significant than one executive's departure. Every other major precious metals desk on Wall Street is staffed with traders who were trained in the same philosophy, used the same models, and made the same assumptions. They are all short. They are all underwater. And they are all now terrified. Think about the psychological shift occurring in those trading rooms right now. If you are sitting at the J.P. Morgan Commodities desk or the Citigroup Metals division, and you see that the head of precious metals at Goldman Sachs just got fired for fighting this rally, what do? You stop fighting. Immediately. You do not care anymore whether silver is overvalued according to your models. You care about keeping your job. You care about not becoming the next executive casualty in a market that is bigger than your algorithms predicted. So you cover your short positions. You stop selling paper contracts to suppress price. You might even start buying to protect yourself from further losses. This is how a short squeeze transitions into a full-scale institutional panic. The traders who historically provided resistance, who capped rallies and enforced price ceilings through relentless paper selling, are being removed from the battlefield. The human wall is collapsing, and without that resistance, there is no ceiling left. While Western banks are suspending operations and Wall Street executives are being terminated, the Eastern Hemisphere is engaged in an entirely different activity. They are not analyzing charts. They are not debating valuations. They are accumulating physical metal at a pace that has broken the global pricing mechanism. What occurred overnight in Shanghai represents more than a rally. It represents the complete decoupling of physical metal markets from Western paper derivatives, and the beginning of a new pricing regime that will render New York's COMEX exchange irrelevant. The data coming out of China on January 26, 2026, is the kind of data that forces analysts to re-examine their foundational assumptions about how commodity markets function. Silver, on the Shanghai Gold Exchange and Shanghai Futures Exchange, did not rise incrementally. It exploded. The session closed with a gain of 12.78% in a single trading day. The final price was $122.95 per ounce. For context, a 12% move in a major commodity market in one session is extraordinarily rare outside of geopolitical shocks or supply disruptions. This was neither. This was pure demand overwhelming available supply in a market where physical delivery is mandatory, but the price itself is only part of the story. The critical element is the gap. Silver closed in New York at $114. Silver closed in Shanghai at $122.95. That is a spread of nearly 9 per ounce between the two largest silver markets on the planet. Under normal market conditions, such a spread would be impossible to sustain. Arbitrage traders would immediately buy metal in New York, ship it to Shanghai, and sell it for a guaranteed profit. That arbitrage mechanism is what typically keeps global prices aligned within a narrow band. But that mechanism is broken down entirely. Because there is no metal available in New York to buy and ship, the COMEX warehouses are functionally empty of deliverable inventory, the refiners are back-ordered into 2027. And even if metal could be sourced, the premium in Shanghai tells you exactly where it is going. East, not west. The implications are staggering. Western institutions that are short silver, the same institutions that just fired their trading executives and suspended retail sales, are now watching physical metal trade at a $9 premium on the other side of the world. They cannot deliver, they cannot cover. They are trapped in a paper market that has lost its connection to physical reality. And Shanghai was not an isolated event. The entire precious metals complex in China went vertical. Gold surged 3.6% to close at $5,113 per ounce. But the price action, as dramatic as it is secondary to what is happening in the vaults. The Shanghai Futures Exchange publishes daily inventory data, and that data reveals a trend that should be front-page news at every financial publication, but is instead being ignored by Western media. On January 26th alone, 7.3 metric tons of silver were withdrawn from registered vaults. Not sold, withdrawn. Removed from the exchange entirely and transferred into private storage or industrial consumption. The total remaining inventory in the Shanghai Vault network now sits at 18.4 million ounces. To understand how catastrophically low that number is, consider this. JP Morgan claims to hold more silver in a single vault in New York than the entire Shanghai exchange system currently has available. And China is the largest consumer of silver on the planet, driven primarily by solar panel manufacturing, electronics production, and investment demand. 18.4 million ounces represents approximately 2 weeks of supply for China's industrial sector. That is not a buffer, that is fumes. When a market is running on fumes, price discovery becomes exponential rather than linear. The seller of the last available bar does not accept the previous price. He names his price. And if you want that bar, you pay what he asks, or you do not get the bar. This is why Shanghai closed at $120, while New York closed at $114. This is why the spread is widening rather than narrowing. And this is why Western shorts are facing a crisis they cannot solve. Because here is the final piece of the puzzle that ties everything together. If you are a refiner in Switzerland, and you have 1 bar of silver to sell, where do you send it? Do you sell it in London for $114? Or do you put it on a plane to Shanghai and sell it for $122? The answer is obvious. You are a capitalist. You sell to the highest bidder. This creates a super vacuum. Physical metal flows toward the highest premium. And once it arrives in the East, it does not come back. It is consumed by industry, absorbed by investors, or locked in vaults that will not release it at any Western price. The West is being starved, not by politics, not by sanctions, but by mathematics. The metal is flowing east because the East is willing to pay more, and the West has no inventory left to compete with. TD Bank suspended silver sales because their vaults are empty. Goldman Sachs fired their trading executive because he shorted a market being drained by a vacuum he could not control. And Shanghai is closing at record premiums because they are buying the last available physical supply on the planet. This is not a cycle that reverses. This is a structural shift. The buy button in the West is not coming back. The metal is gone. And the business leaders who understood this reality 6 months ago are now watching from a position of strength, while those who waited are discovering that their cash is trapped in a system that no longer offers an exit.